I don't want to be that guy, but I need to give you a little bit of a stock market warning for the month of September. There's a couple things that might be brewing in the background. If they all coalesce together, it might be bad news bears. Now, I don't want to be that guy who's doomsday, doomsday, doomsday. Of course, there's the bull case, there's the bear case, and I think these are just the things you should pay attention to. So first and foremost, on the screen right now is the seasonality of the S&P 500 over the past 20 to 30 years. So you can see September choppy at first, then it spikes, and then it vomits into the end of the month. So September from a seasonal perspective is a very choppy month. If you're looking at it for the NASDAQ, you're gonna see same thing, just not as extreme. Kind of flat at first, then it spikes, then it comes down to the end. That's just how we've seen things play out historically. So you should think, okay, a little bit, maybe bullish at one point, maybe then a little bit bearish, but not a nice trend like we see in the certain months of July or December, something like that, where those are just like clearly in one direction. So for this particular September, what might cause it to break in the bullish direction or the bearish direction? Well, let me share some information with you. Government hiring is inflating jobs numbers. So if you've been listening to anything about the economy or paying attention to the stock market, you might have been hearing, okay, inflation was high. It seems like it's trending in the right direction. We're getting it where it needs to be. It's not exactly perfect, but it's not exactly horrible. But what you have been hearing about as well is a weakening labor market. We're seeing, unfortunately, the unemployment rate go up, which for those of you who are paying attention to unemployment, don't forget this Friday, September 6th, I hope you're listening to this in time, we're getting the next unemployment rate, and they're actually expectation is higher than it was. So they keep raising it. Last time it was 4.1 and it came in at 4.3. Now they're expecting 4.2. So Wall Street, all these analysts, the median value, the average value of their expectation is unfortunately that more people will be unemployed. So obviously you got to pay attention to that. But anyway, private sector jobs growth as percentage of total payroll growth fell to 38% in July, the lowest level since the Rona period. Historically, every time the private payroll growth share fell below 40%, the US economy was in a recession. You know that thing that we thought we were in, and then they changed the definition of what a recession is, and they're like, look, we're not in one anymore. Even though the economy is bad, we're just changing the actual meaning of it. This also means that most of the employment growth over the last few months has come from government jobs. You know, those people that we give money to and they spend way too much of it and they're hiring. Well, it feels like they're playing a little loosey-goosey with the rules of all this. So obviously we're getting the unemployment report this Friday. It comes out the first Friday of every new month, but a little bit after that, you have to pay attention to the FOMC, the Federal Open Market Committee meeting. This is going to be the main event of trading in the month of September. On Wednesday, September 18th, we're gonna find out, are we gonna get a 25 bips rate cut or 50 bips rate cut? As the point that I'm recording this, there is a 2/3 chance of a 25 bips rate cut and a 1/3 chance of a 50 bips rate cut. So we know they did this to fight inflation, that now they think that they got a control on inflation. It's time to bring that Fed fund rate down, start to drop yields. Now, the argument is, we know that maybe we were a little slow to react, but the question here is, did they overdo it? Because not only did we see pressure on the labor market, but we're starting to see signs of elsewhere cracking. Bank of Japan governor reiterates that the BOJ will hike rates if outlook is realized. So this is, you know how I said that there's multiple things coming together? If we're gonna cut our rates and the Bank of Japan's gonna jack theirs up, that means that the USD JPY pairing is gonna drop, and that puts pressure on the yen carry trade, which was the exact thing that caused this early August drop. So we dropped and they're like, oh no, we're fine, because really 2 days after it happened, really what happened was here on Wednesday, July 31st, the Bank of Japan did a surprise rate increase. People were like, whoa, we didn't expect you to do that. And then everyone started to look at the USD JPY pairing on the screen right now. So they're like, oh, okay. And then we thought we were going to start to recover some stability here until about mid-August. But as you can see, looks like we're still putting in some lower highs. So that's once again kind of on the menu concerning people. So the Bank of Japan going to jack theirs up. We're most likely going to get ours cut in September 18th, Wednesday. Definitely mark your calendar for that. But where is other pressure going to come from? Well, look at this. Small bank credit card delinquency rates just hit a record high. So this is small versus large, but you could even see in large right here, this is even spiking. So across the board, there's some concerns, and that's what I'm referring to, of cracks in the system. Something to pay attention to, and obviously we're going to get more information, more of an idea of what this really means come mid-September. But the other thing I want to bring to your attention is this right here. We are 15 days away from the first Fed rate cut of this cycle. Using the same time frame, we overlaid the following 4 past rate cuts: 1981, 1990, 2000, and 2007. These 4 cutting cycles match the same day that we've seen currently. Unemployment rate curving up, 10-year, 2-year inversion, etc. So those are all the big economic things that a lot of people are focusing on. The sentiment from the bulls is that the rate cuts are suitable for the market. This is true in the long run. History shows that the market pumps on average for 25 days after the rate cut, followed by an average of a 13-month sell-off. So what this is saying is, if you're bullish or bearish, the answer to that is on your time frame. It's bullish in the very short time frame, as in a couple weeks. Then if you start to look at a handful of months, it actually favors the bears, where if you look at any rate cut cycle in US history, if you're looking about that anywhere from 8 to 14 months, we always have a double-digit drop. Then we bottom, and the long run becomes even better. So basically, short-term bullish, medium-term bearish, long-term, it always pays to be a perma bull. So when it comes to, oh, are you bullish or bearish? Well, the next question to that is, well, what time frame? Up into and including the rate cut, I think the bulls are still in control. Right now, we're still in a very positive gamma environment. But when things start to come down on the backside of it, fast forward a couple weeks from there, from the rate cut, I think that's a very legitimate point where we might see some of the cracks in the economy, especially the weakening labor market, really start to present themselves within the stock market. So once again, I don't want to do this to be a doomsday guy. I just want to present you with the information that I think is pivotal to your current trades right now. And in terms of bullish or bearish, well, if you want me to answer that, it all depends on the time frame. Do I know if things are going to go up or down? God, no. It's a 50-50 guess. But what I'm very confident of is wherever we're going to go, it's probably going to be a pretty volatile, large range ride. So as long as you're protecting your risk and then riding the trend, I think this is actually, in all reality, a great opportunity to make some money.